Hi, I'm Felicity, a registered nurse, cosmetic injector, and founder of the Fit Injector Clinic. Welcome to my channel and video podcast streaming on YouTube, Spotify, and Apple. Today is episode 10, and I have Jacob joining me today. Welcome, Jacob.
Thanks for having me, Felicity.
Thank you so much for coming on. So Jacob is the Director of Advisory Corp Accountants here in Sydney and also a client director at Latitude Accountants. Now, Jacob reached out to me wanting to bring a numbers and tax spin to the podcast, which I thought was fantastic to give value to fellow business owners, particularly those in the cosmetic, health, beauty, and wellness space. So today we're going to be learning from Jacob tips on setting up your business structure, all things GST, common tax deductions in this space, and record keeping tips, and also requirements when it's time to hire your first team member and tax planning hacks. Really looking forward to that bit.
Thanks.
So let's get into it. So Jacob, tell us a little bit about yourself and your background in accounting.
Absolutely. So my name is Jacob. Thanks for the introduction. And by the way, it's a very professional fit out. You can't see this behind the camera, but this is probably the most professional production that I've ever seen. So kudos to you for making this all happen. So I'm Jacob Farmy. I'm a chartered accountant, client director at Latitude Accountants. I came up through the mid-tier space. Sort of top 10 firms, stayed there for about 4 or 5 years, and then realized that the people I wanted to help were the up and coming young small business owners who wanted to get out there, have a crack and create some generational wealth. So I started a firm called Latitude Accountants, was there for maybe 3 years, 3-4 years, stuck it out there for a little bit, grew the business with a couple of the original founders. Got to a point where I was doing so much of the growing the systems, growing the processes, being the technician, that I thought I could probably have a crack at this on my own. So I did. Started Advisory Corp Accountants. Did that for 3.5-4 years at the start of the COVID, and then grew up a really decent ledger. And then reached back out to, we had conversations with Latitude Accountants. We ended up doing a merger in April. So the goal of that is to build something special together. Our vision at Latitude Accountants is that we believe the small business owner is the hero of our community. Why are they the hero? Because they're the ones who create the jobs. They're the ones who create vision, put up spaces like this and do things like this to move the community forward. Our goal is to help, our vision is to help 1,500 small business owners make their dreams reality. We do that in 3 ways. One, we help you manage your tax, which we'll talk about toward the end there. So manage tax, understand your numbers, and navigate the small business journey. So that's a bit about who I am, what I do, and the story.
That's great. I love that.
Thanks.
So, Jacob, who are your customers?
Yeah, absolutely. So we have 3 typical clients, I would say, but mainly what connects them all is service-based small business owners looking to create a business that provides opportunity for themselves, their families, and their communities. That's the underlying. Who typically age between 25 and 40. The 3 types of people we deal with mainly, we deal with a lot of small businesses, and we like the variety, but the 3 main ones are professional services, and that includes things like cosmetic, health, all that sort of stuff. We deal with construction. We have quite a few builders on our books as well. We help a lot of builders take themselves to the next level. And then the general chippy, the plumber, the carpenter, all that sort of stuff. So the tradie as such as well. And then one of the other main outlets is the creatives. So myself, I have a lot of digital agencies on my books, influencers, and just anyone with a creative mind that wants an outlet and wants to monetize that outlet. And so, that's
fantastic. A really good range. And I'm sure you learn so much about other people 100%. And their businesses. Yeah,
absolutely.
That's really great.
Yeah.
So how to set up your business in terms of business structures. So sole trader companies, trusts, and pros and cons of this.
Absolutely. So like you said, well researched. So there's 3 main structures that people operate out of. The sole trader, the company, and the trust. And there's often structures that incorporate a few of these. So for example, some people might have companies owned by trusts and things like that. So there are multiple different ways you can structure your business, but I'll talk about the main 3 and the pros and cons. Sole trader, what are the pros of being a sole trader? Easy to set up, get an ABN and off you go. So probably the most simple of the lot, and the least amount of compliance and red tape and accounting fees as well. Some of the downsides of being a sole trader, there's 2 mainly. One is unlimited liability. In layman's terms, you are the business. So if something happens in the business, you are liable as the business owner. And that could be damaging especially if you have assets in your names and things like that. Business is a risky environment generally. So we try to minimize some of the risks. So sole trader is a risky thing to run out of. Not bad when you're first starting out and having a crack, but as your business grows and as your risk grows and as you get staff and things like that, you may want to think about other structures. And the other downside of a sole trader is highest marginal rate goes up to 47%, over 180 grand. So there are two downsides with that. There are structures that mitigate some of those risks. So for example, a company would be the next structure over. The upsides of a company, as opposed to unlimited liability, we now have limited liability, hence the term PTY limited. So you incorporate and you get what we call the corporate veil. So you sit on one side, the business sits on another side, and there's a corporate veil or effectively a shield that covers you from the risk of the business. Yeah. Most cases, unless you're committing, committing fraud,
really doing the dodgy,
and you're trading insolvently, or the director can be up for grabs for some serious stuff. But generally, limited liability protected from the business risk. Yeah. That's one of the main upsides. That's one of the best insurance policies that you can have in business. And then the second upside is it's a 25% tax rate on retained earnings. So
which is a big difference.
Massive.
To a sole trader.
A lot of people. It is a massive difference, but a lot of people think that, great, I'll just set up a company and then I'll pay 25% tax. But if you want to take the money out of the business, then you have to top up the tax at the personal level. So it is a misconception. It's great, 25% tax rate for retained earnings and things you're keeping in the business. But if you do want to start stripping that money out and doing things at a personal level, you do have to top that tax up. So that's a common misconception as well.
Yeah.
But they're the two main upsides. And then the downside of a company, more accounting fees. So more accounting fees, more red tape. You're now registered with ASIC. And there's just more checks and balances you need to put in place. Yeah. It's not as easy to pay yourself. So as a sole trader, people get used to just having a bank account and ripping money.
Just taking money. Yeah.
Exactly. But when you're a company, there's more stringent ways. You have to pay the dividends, or you have to pay salary and wage.
Be on payroll.
Exactly. So your business is employing you now.
Yeah.
But it's a separate legal entity. So there has to be mechanisms to do that. And what you want to avoid is just ripping money out, because then you have what we call Division 7A, but it's a fancy way for saying you can't just rip money out of the business without paying tax on it. So that's a company. The next structure over would be a trust. And just on that with the company, there's a few key roles in the company that you need to be aware of. Who the director is, who the shareholders are. They're some of the important roles in the company. So I mentioned that because it flows into what I'm about to say.
Yeah.
So the third structure is a trust. A trust operates for the benefit of other people, i.e. its beneficiaries. So I would say if I had all businesses, probably 35% trade out of a sole trader, probably 50% trade out of a company, and then probably 15% would trade out of a trust.
Okay.
But it's not it's a common thing that we see where a company is set up, but a trust owns the shares in that company. Gives you the best of both worlds. Let me explain what a trust is and explain why that's important. Like I said, a trust is something that benefits that operates for the benefit of other people, its beneficiaries. A trust cannot retain its earnings. So a company, you make profit and it sits in the company unless you decide to pay it out. In a trust, the profits must be distributed every year.
Yeah.
You have to do resolutions before 30 June to clarify that distribution. And it's essentially something where if you want to retain earnings, you can't. You need to push it out to its beneficiaries, and then its beneficiaries will determine what to do with it. It's a more complex structure. There are more things involved. It also needs a trustee. Oftentimes we put a company as a trustee, but you can be an individual trustee, but common practice is to put a company as a trustee. And so you can run a business out of it. Many people do. But one of the main things that people use trust for are as an investment vehicle or as a asset vehicle. So you could potentially own shares from that trust. You could potentially have property in that trust. There's pros and cons with all of these things. It's very nuanced. You should see an accountant when you're deciding. But they're the typical structures. Upsides of a trust, the trust has no tax rate in itself. the trust distributes money out to its beneficiaries and they pay tax at their own rate. So you might have a tax rate of 25% because you're distributing to a company. You might have a tax rate of 47% because you're distributing to a higher net worth individual. So one of the upsides we say is that it has no tax rate. You still get a layer of the corporate veil if you have a corporate trustee in there. But the downsides to the trust are it's probably the most complicated structure. It probably has the most red tape. And it's probably the least understood and most evolving. So the ATO constantly is working with trusts and redefining what a trust is, what it can do, what it can't do, and there's a lot to keep up with there. So they're the three structures, and like I said, a combination of all of them. But
pros and cons to all of them.
That's
I suppose it comes down to everyone's individual situation. And like you said, some people move through them. Like I started as a sole trader and that worked beautifully when I was just me. Yes. But now I'm a company and that works so much better. Now I've got staff and a lot more things going on.
That's right. So like I said, as you evolve, so every year, typically with our clients, we sit down and review the structure, and it's fluid. You're right.
That's great.
There's heaps of moving parts. So like I said, get the advice. For some people, sole traders, right? For some people, companies, right? People rush into different structures too soon as well. I've seen that. So it's really worth having a conversation, like you said, and making sure it's fit for purpose for what you're trying to do.
Exactly. And seek advice from the experts.
We did.
Don't try and wing it.
Yeah. Effectively.
Totally.
Yeah, that's right. Absolutely.
That's great. So next topic is all things GST. So what does GST mean and when should you register for this?
That's a great question. So GST, misunderstood a lot as well, similar to the 25% company tax rate. Everyone thinks they just pay tax 25%. But GST is a tax on consumption. So it's actually a consumer tax. Businesses typically don't actually pay GST. They're just a vehicle that GST moves through. So what we have is the ATO on one side, the consumer on the other side who ends up paying the GST, and the business owner sits in the middle. And the business owner will charge an extra 10%. So 10% in Australia is the rate. Will charge an extra 10% to the consumer, collect that 10%, and then give that 10% to the ATO. So often with our clients, what we say is if you're registered for GST and you're charging GST, keep aside at least 10%. It's probably a bit less because there are claims on the other side, but keep aside 10% because every time we lodge BAS, you need to give that money to the ATO.
Yeah, which can be a bit of a shock every
100%.
quarter.
Especially for a sole trader just starting out, just registered for GST or whatever. You need to make sure you're across this. So what is GST? It's tax on consumption. How does it work? So there are certain people who are by law required to register for GST from day one. So for example, if you're in the rideshare economy or if you're a taxi driver or something like that, you are required to register from day one.
Okay.
Yeah. But most businesses have up until $75,000 of turnover to register for GST. So it's if you reasonably predict for the next year that you're going to hit 75 grand, or if you've already hit 75 grand, you have 21 days from that point to register for GST.
Great.
Once you register for GST, you need to lodge typically, when you first start out especially, a quarterly business activity statement. That business activity statement tells the ATO how much GST has come in and gone out of your business. Depending on if you hire people as well and if you're a tax-paying entity, your BAS can be made up of the GST that goes in and out of your business, but it also has the amount of wages you've paid out to staff, the tax withheld on those wages that you've paid to staff, and potentially a pay-as-you-go installment, which is a prepayment of your income taxes throughout the year. So the first few BASs is an education process, as well, like you said. But and what I would typically advise for all businesses is you really need to have a tax saving account in your business and make sure you're putting money aside so that when these tax liabilities come up, you're prepared and you're ready and you've got that money aside. There is nothing worse than trading for a quarter, using all the cash, and then your accountant telling you, hey, the taxes that we should have paid on the wages and then the GST. And
it's due at the end of this week. So.
Exactly. Effectively. Exactly. So very important that you understand what's made up on the BAS and that you're staying on top of that. GST, ironically, in your space is quite nuanced because GST typically in the medical space is GST free. So medical practitioners who are providing medical services, whether it's Medicare or whether they're a part of APRA and things like that, and they're providing a verified medical service, that is GST free.
Yes.
But most businesses, I'd say like 80% of businesses charge GST. There are some supplies that are GST free, and there are some expenses that are GST free. But again, 90% of expenses have GST in them.
Yeah.
And then there are some that have that are GST free. So it's important that get someone to help you understand what has GST and what doesn't in your specific business, and then B, keep good records of that. And I'm sure we might touch on a few
definitely
ways to keep track of all that sort of thing.
Yeah. And like you said, this is quite an interesting space because I'm a registered nurse with APRA. I provide medical treatments.
That's right.
But there's no Medicare rebate. There's no private health rebates in this space. So it's like we were saying before we started, it is a little bit of a grey area.
That's right.
Yeah.
Absolutely. So cosmetic is one of those things that it's sort of it is sort of touch and go. And then, so like I said, you would definitely need an accountant to get across that and go through the facts to assess whether you should or should not be charging GST.
Yeah.
So cosmetic is really one of those really in the grey area, especially it's straightforward when you're a GP getting Medicare subsidies and things like that. But if you are in this private space without Medicare rebates, there's an argument either way. So very important to make sure you cross it. Yeah.
Totally. Yeah. What are the common deductions for those in the cosmetic, beauty and health space?
Absolutely. So obviously depending on whether you have staff and things like that, these change. But you know what I'll do? There's 3 golden rules. I thought I made this up, the 3 golden rules, but then I checked the ATO website and I think this is wording on their website that I've
so we
read
can't
in the
trademark
past.
it for you.
No, I know. It sucks because it was one of I thought that was a Jacob Farmy special. But anyway, it is what it is. So there's 3 golden rules to any tax deduction. Number 1 is you must have a record of it. So you must have a receipt or something like that. Number 2 is you must have spent the money and not have been reimbursed. So for example, if you've paid for something, but your employer or someone has given you that money to cover you for it, it's not deductible to you. And then number 3, it must have a connection or a nexus. It's essentially a connection with deriving or making your assessable income. So as long as there is a connection between the thing you've spent, you got a receipt for it and you weren't reimbursed, that is a tax deduction for your business. Common examples looking around us. So, your rent is a tax deduction to you. All of your cost of goods, so that top line cost of goods, the injectables you buy, whether you're a beautician and you're buying the makeup or whatever that is, your cost of goods, your direct inputs to deriving your assessable income is a tax deduction, and it's probably a significant tax deduction for you. The staff that you use in your business, any contractors and suppliers that you have, potentially depending on, so it's common practice when everyone starts a business, the first thing they want to do is buy a car and write off on tax. That's like the most common thing we see. You need to make sure you're aware of whether a car for you is tax deductible or not. It generally is if you're driving from work to work or work to see clients and things like that. But only home to work to home travel is actually not deductible. And there are implications in other taxes when you buy a car. It's not as straightforward. We'll buy a car, we'll write it off in the business. Everyone thinks they just get a car for free when they start a business. That's it.
The write-off people,
right? I've actually got an Instagram really about that. The write-off, I'll send you a link. The write-off people, we just buy stuff and write it off.
You buy a car for 80 grand and it's all free, right?
Exactly. But behind that, there's so many. There's so many. The car depreciation limit, the FBT implications, keeping a logbook, all that sort of stuff. We could spend 10 minutes talking about cars in itself in business, but and then subscriptions, telephone, internet, for business use. What you also have to make sure about as well is that anything you run through the business has to have, especially with like things like telephone. So work phone is going to be fine, but if you've got your mobile and you're using that for work, there might be a private element to those sorts of things as well. So at the year end, when you're sitting down with your accountant, they might ask you, what's the private use percentage of some of your expenses, and you would be expected to back some of the private usage out. But generally, anything connected with your business, helping you derive assessable income that you have good records for, is a tax deduction.
Right.
So that's a long way of saying anything that helps you make income.
Yeah, fantastic. And I think the main takeaway is just being able to make that connection with the business.
100%.
Hope you're enjoying this podcast. Today's episode is sponsored by the Fit Injector Clinic Mentoring Program, business mentoring for cosmetic nurse injectors. If you are a registered nurse who wants to become a cosmetic injector or an existing cosmetic injector who wants to start their own business or scale up your existing business, I have just launched an online version of my mentoring program with video modules for you to work through in your own time, downloadable information for you to keep, and a strategy call once you've completed that with me for 30 minutes to answer any questions that you have about starting or scaling up your business. If you want to get started, email me at admin@thefitinjector.com.au. You see people, like you said, just sort of willy-nilly like spending money on all these things, right, especially coming up to like the end of the financial year, and they're just like buy. And it's you have to pay for this stuff. You don't just get the money back.
100%.
And I think that's definitely a misconception.
100%. Totally agreed. So,
Great. All right, Jacob, what are your tips to hiring your first employee, and what are the requirements for a business?
Absolutely. Great question. So this one is one I think you should engage an accountant and a lawyer, particularly in the employment space, to help you go through. So number one, make sure you have good contracts and agreements in place. Speak to a lawyer, speak to a HR consultant, whoever it is that you need to get that off the ground. So paperwork, very important. Number two, insurances and things like that. So making sure, if you're a company, that you have workers' comp insurance for them, and making sure you've updated all your insurance policies to now you have someone that you're responsible for as well. The third thing, from the accounting perspective, there's two important documents when you hire someone: the TFN declaration form and the super nomination form. So as an employer, once you've hired someone, you're now required to withhold taxes for them and pay their super, or pay super on their behalf. The two forms that help you do this, like I said, are the TFN declaration and the super nomination form. Once you've gotten those details, speak to your accountant / use your accounting software. A new it's new. I say it's new, but it's probably been around for 2-3 years now. Is single touch payroll. So once you hire an employee, you're required, and if you have a company, you're probably going to be an employee of your company as well. So you're required to register for single touch payroll and be up to date. They've actually just upgraded to STP 2. I'm sure there'll be a 3 at some point in the future, but whatever it is. Get a payroll software or a bookkeeping software that has payroll inbuilt. For example, Xero is the one we use, but most softwares can. Look, I've used a lot of the softwares. I try not to be biased, but what we find is, small businesses love Xero. So there's Xero, Mile, Intuit, all that sort of stuff, but we always recommend Xero. We think for the time being, it's the best small business accounting software, and we've been using it for a very long time. So set up single touch payroll in your payroll software, add your employees to that payroll, and then start running the payroll cycle, whether that be weekly, fortnightly, monthly, whatever it is. And then make sure you're accruing the right leave for them if they're a full-time employee in the business or permanent in the business. If they're casual, making sure you're paying all the minimum awards and things like that. So again, speaking with a lawyer, HR consultant, accountant all together is going to be a good idea to make sure it's all above board. And then obviously when BAS time comes around, you've got your W1, W2, and now you're going to feel the pinch of an extra amount of tax withheld. What we usually advise is that when you sit down with your accountant or when you start running the payroll, there's 3 things that happen in your payroll. So number one, the gross amount that you're paying them, so the $1 per hour, then the super amount that you're obliged to pay, then the withholding tax that you're obliged to pay, and then the actual net payment that you would transfer to your staff member on a weekly, fortnightly basis. What's important, we often recommend the tax account, and rather than simply transferring the net amount, transfer the super amount and transfer the tax amount into that separate bank account. There's a timing difference, and I think that's where a lot of people get stuck. The net that's going to your employee is happening in the week you pay them or whatever it is. But then the super and the tax is due a quarter after you've actually made, it's due at the conclusion of the quarter that you've made the payments on. So for example, super is due 28 days at the conclusion of the quarter, and that must be paid on time. There are severe implications if your super is not paid on time. There's SG forms that need to be lodged. And it's really, honestly, as a good business owner, you should be paying your staff their super because it's part of their future. And you're investing in your staff. So making sure your super is paid on time. In order to do that, you can transfer the amount. You can actually transfer it as much as you want, even into their super fund.
Yeah.
Just making sure you have the right things set up and in place to pay their super. And then, like I said, the tax withheld is not due until, typically, if you're with an accountant, you're going to have at least, say, 6 weeks after the quarter's end to lodge that BAS. So just making sure you have that money aside, that when that stuff comes around, you're ready to go.
It's there and you're not worrying about where you're going to find that money.
Exactly. So they're the main sorts of things you want to think about when you're hiring. Hopefully I've covered it all.
Yeah, you definitely
they're probably the main things.
Yeah, that's really good. And I also I want to say with Xero, how you can set up the super to all happen very automatically on there as well. Yeah. So it does make it really easy for business owners. Sort of takes all the guesswork out of it.
That's right, 100%. Yeah. That's one of the best features of Xero. Clients love that. There is a premium subscription for it.
Yeah.
But what clients always ask is that I run the payroll, but then I still need to transfer the net amount, or you batch pay it, whatever. But with super, it actually debits your bank account instantly.
Yeah,
so absolutely, it's a great tool.
So you're not going to forget any of that.
That's right.
Yeah,
that's right.
Very totally. Cool. So how do you recommend to maintain records? What sort of tips have you got for that?
100%. So look, depends who you are. When you're a sole trader starting out, a full-blown accounting software, you might think that, is a little beyond you and you may not have the time or expertise and money to invest in something like that. Yeah. So what we advise for sole traders who are first starting out is go and keep a separate business bank account. Make sure all the business income goes into that account. Yeah. Make sure all the business's expenses go out of that account. Yeah. That way we have one clear thing where we can identify money in, money out, and we know we have a good idea of the profits and the expenses and the income you're making, right? That's the first step. Yeah. As a sole trader, separate business bank account, and then you might have a Google Drive or a cloud, whatever cloud. There's million box, whatever it's called, Dropbox, or that you can start taking photos of your receipts and uploading into the Google Drive or uploading into the Dropbox or whatever. But you've also got that one business bank account where it's easy for your accountant to work out at year end, or if it's easy for you to work it out year end as well. That's step number one. Yeah. Once you're beyond that, especially if you're in a company, I would never recommend a company run like that. No. With a company, I would always start an accounting software. Definitely. Again, like I said, we use Xero. We recommend that for all our clients. Yeah. It's simply at the moment the best small business software in our opinion. So using a Xero software where you connect your bank feeds live into Xero, you have a live snapshot of your business at any given moment. And it's important not only for record keeping, it's important to understand where your business is at any given moment, to have a good conversation, good robust conversations with your accountant on where your business is at, and even just to have that visibility. So setting up a good bookkeeping software such as Xero, and then within Xero, there's multiple options for how you keep records and receipts and things. Xero has an inbuilt filing system. I'm not sure many people know about this, but if you're in Xero and you're listening to this, click on your file name, and then the second option, first or second option will be files. Yeah. You can actually file things within Xero. So if you're on the road and you're taking photos, if you're getting receipts and things and you're taking photos, you can upload it straight into Xero.
I didn't actually know you could do that.
Not a lot of people do. Or you can use there's two connections to Xero. Xero has HubDoc, which is a purpose-built software where you can just take photos of your receipts and it uploads it to Xero for you, or Receipt Bank / I think they're rebranded Dext nowadays. There's options there as well. Depending on if you use a bookkeeper or not, like some of these things your bookkeeper will have access to and will help you with, or if you're just managing it yourself, that's fine as well. Just make sure you're keeping those receipts somewhere. You could even use like the Dropbox or the Google Drive or whatever it is as well. Reconciling all your transactions, running your payroll, and invoicing out of your accounting software, or you might have a POS system that connects to your accounting software, or there's a few different we've seen in the health space, we have Clinico or whatever that talks to your accounting software as well. That's an option. Absolutely. That's an option as well. So that's pretty much everything you need to keep a record of. So like I said, making sure you keep good records of your receipts, you have them there in case in case they're ever required, and you have the right GST because you've got those on your invoices and things like that.
Great.
So that's how I would maintain my records.
Yeah, fantastic. Thank you. So tax planning hacks to look out for are paying more super, writing off bad debt, instant asset expensing, etc.
Absolutely.
Take it away.
Yeah, awesome. So this is something we love talking to our clients about. Like I said, we have 3 missions at Latitude Accountants: help you manage tax. We do that through tax planning and tax compliance, understand your numbers through budgeting and Xero and all that sort of stuff, and then navigating small business journey. So for example, hiring your first staff member, buying your first property, and the accounting and related to that. So this is a great question. The first thing you need to do from a tax planning perspective, and something we review with most of our clients every year, is understand your structure and understand how to use your structure. So for example, if you've got a company, determining, if you're going to pay bonuses, dividends, anything like that at year end. If you've got a trust, making sure you're doing your year end resolutions before 30 June, making sure you know where you're distributing to, and the laws in its nuance depending on the industry, what you can and can't distribute to people, whether you have employees, whether you're driving income from a business structure. There's so many things that go into place. But number one, making sure you have a good structure and review your structure on a yearly basis.
I like that.
That's where I would start. 100%. So that's where I would start. Then I would start looking at there's some age-old things, but I'll go through every year. The federal government releases the budget, and there's always something in there for small businesses that you want to make sure you're across. So for example, a lot of the tax planning we did at the end of the last financial year was talking about the technology investment boost, I think it's called, where any money that you spend in regards to your technology, you actually get a 20% extra deduction for when you lodge your tax return. And that ended at 30 June 23. But it's something that if you've known about, you can put yourself in the best position to capitalize on some of those things. So if you were waiting to buy a laptop, pre 30 June might have been the best time to do it, to make sure you get that tech 20% extra boost.
Yeah, that's fantastic.
Things like instant asset expensing. So I'll touch on that one. So prior to June 23, there was actually no limit. Cars have their own world, but generally if you're buying equipment for your business, and you're a small business, there was no limit on how much you could spend and get an immediate expensing for. So typically when businesses buy equipment, they are depreciated over the life of that equipment. And the ATO has a guide of, how much you can claim each year. But every year there are limits for the first X amount to be written off instantly. Last year that was unlimited, which was a crazy, it's just because of COVID and they were trying to invent.
Sort of unheard of.
But so now that's back down. I actually thought they were going to get rid of it completely. Now that limit is $20,000. Okay. So any piece of equipment you buy for your business under $20,000, that's not a car. Well, even a car under $20,000 is fine. There are other implications, but they can be immediately expensed in your business. You don't have to depreciate them over the life of the asset.
Great.
So you're essentially bringing potentially like a car that costs 15 grand, rather than claiming, that's at 8 years, rather than claiming it over 8 years, you can claim it in year one.
Great.
So having a look at what that limit is for that year and making sure what you can spend and what you can't spend. And I also want to preface this because I know we spoke about this earlier. There is no point spending $1 to save 32.5 cents or 25 cents or whatever your tax rate is. We were talking about the write-off people and instantly expensing some of these stuff. You still, the fundamental business decisions should be made from a commercial perspective. Do I need this equipment for my business? Is this going to help me derive more income? Is this adding value and ROI in my business? Yes. Is there a tax benefit to it? Yes, great. But I actually, this burns me a little bit in the tax base. Something that's actually, this is the first time I've ever said this publicly, but I need to say it because I've been seeing a lot on my social media lately. Buying a property, buying an investment property, this is somewhat tax planning related, but buying an investment property simply to negative gear and reduce your taxes, it is not a tax strategy. It is a life strategy, and there is so much more you need to determine than simply, how do I lower my tax bill? I will just go and buy a negatively geared investment property. What about when the interest rates were 2% and now you've taken on debt and all of a sudden the interest rates are 6% and you're struggling based on the tax advice that you can negatively get your property. There is so much more nuanced conversation that needs to be had around some of these things. Same thing with buying assets in your business. Same thing with all these sorts of things. Tax planning is one of those things where it presents opportunity, but you need to balance it off with the commercial aspect of what you're trying to do.
Yeah.
This was just a rant tangent that I wanted on.
I like
but
it.
To be said. Thank you. Okay, so what are the other things? We can't give financial advice around whether you should put more or less super in.
Yeah.
You have to speak to your financial advisor in regards to that. However, the tax consequence of putting money into super, every year there is a limit on how much you can put into super and get a tax deduction for it. That's what we call the concessional contributions limit. But it's a good thing to have a conversation with your accountant. And if there is cash flow that allows you to, and you've spoken to your financial advisor and you want to put more money into super, have a think about what that cap is and contributing up to that cap and getting a concessional contribution and getting that as a deduction for your business. The beauty of that is you get the business deduction, but it also goes into an environment. So super sits in an environment of 15%. Yeah. You might be at 32.5% to 47% outside of that. So there is a tax advantage, even in the long term, of leaving that money in a lower tax environment. Again, speak to a financial advisor. It's not just a tax decision. There are a myriad of other things you should think about. So there's that. Writing off bad debt is one I saw you had on there. So every year you need to review who owes you money. And if you've chased, so let's say you have a debtor or someone that owes you money and they're just not paying you, you've reached out to them multiple times, you've issued a demand, and they might be insolvent or bankrupt or whatever it is. That's money you're never going to receive. So you should think about writing that off as a bad debt and claiming that as an expense, because why would you pay tax on income you're never ever going to receive? So there's things like writing off bad debt.
Is that quite common for service providers?
Look, prior to COVID was one story, but look, business is a tough environment. There are businesses, unfortunately, for every 10 years, 50% of businesses succeed and 50% of businesses fail. So it's probably even, I dare say the statistics is probably even more dire than that. So there are definitely scenarios where, businesses simply can't afford to pay your invoice and you need to think about whether you're going to write that off. Since COVID and since interest rates have tripled and the current economic climate, we are seeing it more common where, and it's just non-committal. Like I've sent you the invoice. Hey, can you pay it? We're waiting on cash and and then months and months and months later, and then it's crappy for both businesses. Business owners are typically ethical people that do the right thing as well, and that will pay their invoices as and when they fall due. But unfortunately, it's one of those things where if cash flow doesn't permit other businesses and they're failing, well, it's a shame, but there's consequences that ripple out accordingly. So good question. It is more common now in the current economic climate. So a conversation I always have with my clients is make sure if you issue your invoices, keep reviewing your debtors listing, or when I say your debtors listing, people that owe you money, review this regularly. What I often say as well is potentially hire someone in-house, or even just for whatever it is a week, just get someone else who is in between you and your customer to make that call for you.
To be your bad cop.
Just so you want to keep the business afloat, you want to keep the business moving. But you don't want to ruin the relationship.
You want to separate yourself from that part.
So get someone in who has that in them. And a lot of business owners typically just don't like that task because when you sign up for business, you don't know.
And when you're building a relationship with your customers, it is hard to also be the person asking for money.
That's exactly right. So yes, more common, but make sure you stay on top of your debtors. Make sure you're reviewing constantly. Don't let people run with the invoice and struggle to pay you. So writing off bad debt, they're probably the main sort of tax planning tools. But every year we come up with a checklist or a strategy that masterclass that has 10 to 20 tips on how to do these things. So I'll have to forward you the 24 and I'll give you the 23 one that would be amazing. Well. Yeah,
that's
for sure.
Great that you do that as well.
Sure. We'll do our best.
Incredible. Thank you so much for tuning in to episode 10 of this video podcast series. You can find us on YouTube, Spotify, and Apple. A huge thank you to Jacob for joining us today. please let people know where they can find you, how they get in contact.
100%. So I'm in this limbo. So my Instagram handle is probably the most easiest place to find me.
Great.
It's Advisory_Corp_Accountants. I am changing it to Jacob Farmy.
Yep.
So that's going to be my personal place that you can find me. And then for the business, Latitude Accountants on Instagram.
Okay.
Is our best go-to, and then you can check out our website latitudeaccountants.com.au.
Fantastic.
And yeah, that's probably the best space. Or just Google my name. I'm sure something will come up.
Yeah, fantastic. And I'll pop all the links so people can find you really easily. Thank you so much for all the information. I found it really interesting and really helpful, and I'm sure those listening agree with me.
Thank you so much. Thanks for having me on. Like I said, extremely professional production. This is the space in itself, if you haven't been here, is fantastic. So it's nice to get out and support other small business owners and to have these conversations.
Yeah, well, thank you so much for reaching out to me. It's great to add, some new and different information on here. Thanks so much.
Thank you.
Thanks, guys. Bye.